This is Money Exchange with Andrew Barnett.
Hello, I'm Andrew Barnett and welcome to Money Exchange, where we keep you up to date each week on everything you need to know about currencies. Well, it's been a huge year for global currency markets, with some monumental central bank decisions throughout the year that has seen billions of dollars made and lost in the biggest financial market in the world. I'm not overstating it when I say 2015 has been a year that will go down in history as one of the most memorable when it comes to central bank policy decisions. Over the next 60 minutes, we'll chat with some of our regular Money Exchange guests from throughout the year to dissect what went on. Did we get it right or did we get it wrong? And did the major central banks make the right policy decisions for a global economy still trying to recover from the largest global financial crisis since the Great Depression? First up, we'll cross to Melbourne to speak with Stephen Dooley from Western Union about our local currency, the Aussie dollar. Where is it headed in 2016? Do we expect further rate cuts from the RBA? And we'll sum up where we think the Aussie will be this time next year. For those techos who love the charts, I'll be chatting with Tony Sycamore, Director of Institutional Foreign Exchange at Commonwealth Bank, about where the major currencies sit technically and what pairs are showing the most strength or weakness. Then it's off to Singapore to chat with Annette Beecher, Head of Asia Pacific Research at TD Securities. China has been the big elephant in the room when it comes to emerging markets. It's meddled with its currency a number of times throughout 2015, lowered its interest rate some 6 times, and its growth outlook seems cloudy. Annette's comments on this program throughout 2015 have been spot on the money, so I want to ask her how China will impact global currencies next year. And we're off to Chennai, India tonight to speak with Zachary Latif from TLG Capital about emerging market currencies and what to expect from the euro and pound looking ahead to next year. But first, let's take a look at this week's headlines. The historic liftoff arrived this week. The US Fed raised interest rates by 0.25%, marking the end of 7 years' worth of zero interest rate policy, and 9 years since they last had a rate rise. Officials were upbeat about the US economy, seeing stronger jobs markets. Here's some of what the chair, Janet Yellen, had to say in her press conference on the decision to finally hike rates.
FOMC participants project inflation to be very low this year, largely reflecting lower prices for energy and non-energy imports. As the transitory factors holding down inflation abate and labor market conditions continue to strengthen, the median inflation projection rises from just 0.4% this year to 1.6% next year, and reaches 1.9% in 2017 and 2% in 2018. The path of the median inflation projections is little changed from September. With inflation currently still low, why is the committee raising the federal funds rate target? As I've already noted, much of the recent softness in inflation is due to transitory factors that we expect to abate over time, and diminishing slack in labor and product markets should put upward pressure on inflation as well. In addition, we recognize that it takes time for monetary policy actions to affect future economic outcomes. Were the FOMC to delay the start of policy normalization for too long, we would likely end up having to tighten policy relatively abruptly at some point to keep the economy from overheating and inflation from significantly overshooting our objective. Such an abrupt tightening could increase the risk of pushing the economy into recession. As I've often noted, the importance of our initial increase in the target range for the federal funds rate should not be overstated. Even after today's increase, the stance of monetary policy remains accommodative. thereby supporting further improvement in labor market conditions and a return to 2% inflation. As we indicated in our statement, the committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. The federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. This expectation is consistent with the view that the neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary if the economy were operating near potential, is currently low by historical standards and is likely to rise only gradually over time. One indication that the neutral funds rate is unusually low is that U.S. economic growth has been only moderate in recent years, despite the very low level of the federal funds rate and the Federal Reserve's very large holdings of longer-term securities.
The Reserve Bank is confident in the economy's ongoing transition in light of recent positive data. In the minutes of its December board meeting this week, the RBA seems content with current policy settings, but says the inflation outlook may provide scope for further easing if appropriate. The RBA is upbeat about the outlook for the Australian economy, forecasting output growth to gradually strengthen over the next 2 years as the drag on falling mining investment diminishes. The Reserve Bank also notes an easing in investor lending as the pace of house price growth moderated in Sydney and Melbourne markets. For the second straight month, the RBA meeting preceded unexpectedly strong jobs numbers. The board says indicators are pointing to continued employment growth over coming months. So, what does it all mean for the local currency heading into 2016? This year we've seen the Aussie dollar fall from a high of 83 cents in January to a low of 69 cents in December. To tell us about what is likely to happen with the Aussie next year, Western Union's Stephen Dooley joins me from Melbourne. Hi Stephen, and welcome to Money Exchange.
G'day Andrew, hope you're well. Thanks for having me on tonight.
The Aussie dollar dropped 14 cents throughout 2015, and looking back, the falls on the currency were fairly obvious early in the year with rapidly falling commodity prices and the RBA lowering rates. Now the Fed has finally started to raise rates. My thoughts are we might see the Aussie dollar slip under 60 cents at some point next year. I'm keen to get your thoughts.
Yeah, well, Andrew, I mean, you talk about the 14-cent range that we've had in the Aussie dollar last year, well, this year, and that's pretty much the average for the Aussie dollar. It normally moves about 19% a year, as we all know. It tends to be one of the most volatile currency pairs. It's not just got the ordinary trade flows, but of course it's very often used as a trading currency to take positions on commodities and of course China. So it tends to be one of the more volatile currencies in the FX market, and so as a result we do tend to see these big moves nearly every year. So far this year what we've seen, that 14-cent range, very much in line with expectations, and as you say, it has been one of those years where it has been certainly a little bit easier to call over the long term, as you say, with commodity prices lower, with a couple of rate cuts from the Reserve Bank of Australia, and of course the US Federal Reserve raising rates. Certainly most of the biases were to the downside for the Aussie dollar. Going into next year, I think we can certainly be reasonably confident that's more likely to be the case next year as well. Again, the big falls we've seen in commodity prices just over the last couple of weeks, crude oil down 20% in a 2.5-week period. The iron ore price at the lowest level in a decade certainly is a negative for the Aussie dollar from one perspective. From the other perspective, the Federal Reserve at their meeting this week suggested they are still thinking about raising rates about 4 times next year. That should cause the US dollar to be stronger as well. So again, this year, looking into the next year, if we assume we get another between 18 and 20% move next year, if we assume that we finish the year at 72, that's going to be around a 13 or a 14 cent move again. And if that's to the downside, then a move below 60 is actually fairly achievable. Whether we end up down there, of course, no one knows, but certainly a move of that size next year wouldn't be unusual by any means.
Stephen, did the Fed catch you by surprise? It's caught me a little bit by surprise how lacklustre the market was after the Fed's rate decision to raise rates by 0.25%. I know that it was probably the most forecast and expected rate decision of the last probably 100 years, but did it take you by surprise? It was a little bit of a fizzer in the end, the market's reaction, wasn't it?
Yeah, look, it was, Andrew, but again, as you say, the case that it was so well telegraphed, we did see a fairly gentle reaction. And if you actually have a look over the four major interest rate decisions we had from the Federal Reserve this year, the one that had the smallest reaction was the one when they actually did something. The meetings where nothing happened saw a much greater move than the meeting that they actually did something. So that's certainly a turn up for the books. But of course, what we're hearing is Janet Yellen now being acclaimed as a great communicator, keeping markets very soothed and calmed going into the announcement. So we had expected a rally in the Aussie, and we were hoping, certainly for our clients, that we might see a little bit of a push up above 73, but we just didn't see the volatility that we might have expected. But perhaps more unusually, it tended to have a little bit of a delayed reaction, and it was it was later in the day, certainly going into the Asian session and going into the overnight session in the US, that we saw the real big move higher in the US dollar. So we did see a reaction, but unusually it was quite delayed, and the actual the reaction to the event absolutely, particularly if you look at the first, the most of the move occurred during the press conference. The actual statement was stunning. It was a 30-point move. A 2-point drop in consumer sentiment can do that to the Aussie dollar sometimes. So just bewildering that markets took it so calmly.
Well, I guess in some respects that was a nice thing that markets stayed reasonably stable. If we have a look at history, Stephen, with respect to the Aussie dollar, we saw the Aussie dollar back at about 50 cents against the US dollar back in around 2000, when interest rates in the US and Australia back then were about the same. The consensus is that rates are going to rise in the US, and we may see rates stay on hold here in Australia for all of next year and potentially even into 2017. That being the case, the interest rate differential narrowing, surely the Aussie dollar must fall if rates and yields are going up in the US and they're staying where they are in Australia. Does that meet your expectations and make sense to you?
Well, the absolute basic DNA in FX markets is that relative interest rate. Certainly, from a pure economic view, as you say, a reduced difference in interest rates, where interest rates are closer to each other in Australia and the US, almost inevitably means that the Aussie dollar should lose value versus the US dollar. So absolutely, that's 100% correct. What's tricky to judge, of course, is how much of that is already baked into the market already, and that's why very often things that should occur according to economic textbooks very often don't occur. Sometimes markets move ahead of things. Sometimes markets will be looking at other key points, commodities, expectations for growth. So certainly the base case is that absolutely, and that's one of the reasons why you look at most analyst forecasts, they expect the Australian dollar to be lower into 2016, and that's the very core of that. If Australian interest rates stay steady, and if the US raises rates 4 times, then we'll be at the end of the year with interest rates just 50 basis points difference, and in that case the Aussie dollar should press press lower. I think the big risk into next year is, of course, if we do see the Reserve Bank of Australia cut rates once or even twice, that gets us to a scenario by the end of next year where interest rates are the same in Australia and the US. And from that perspective, that's when we can really see a sharp move lower in the Aussie dollar over the next 12 months.
Stephen, as we look around the world, we look at the major currencies, the Aussie, the Kiwi, the Euro, the US, the yen, etc. In your view, who's looking the most vulnerable? Last year, the Aussie dollar was perhaps one of the most vulnerable. What, in your view, leading into next year is the vulnerable currency that we could see some serious slide on?
Well, I think, again, you're going to have to look at the Japanese yen. That's been a solid trade for traders over the last 3 or 4 years. They continue to print money. They continue to force interest rates lower. Like we just discussed, interest rates are that core DNA of FX markets. So if we expect to see further stimulus from the Bank of Japan, they've actually engaged in further stimulus earlier today, and that saw the yen weaken, but there's an expectation of even more next year. Then from that perspective, I think we can continue to see further weakness in the yen. I think we've probably got a good chance of seeing another round of stimulus in the middle of next year. From the euro. Again, that sets up a euro that's going to potentially press lower as well. I think there's probably a good chance still that we're going to see more rate cuts from Australia and more rate cuts from New Zealand. If you look at the market pricing in Australia, certainly markets still think the most likely outcome for the Aussie interest rates is for them to head lower. So again, that sets up a move as well. So I think these trends don't completely change on the calendar year, of course. So I think some of those big themes from last year are going to continue on to this year, into next year as well. And that's obviously euro, yen weakness, and to a lesser extent, Kiwi and Australian dollar weakness. Of course, that's going to be a matter of timing as well. Certainly at the moment, they've both been benefiting from a bit of a lift-off on expectations that both the Reserve Bank of New Zealand and Reserve Bank of Australia are on hold for now.
Stephen, very, very quickly, a price target for the euro against the US dollar this time next year. Are we back under parity at all?
I think we've got a very good chance of getting back down under parity, but I think look, we'll put it at bang on parity for the end of next year. But look, it's easily can see it below parity. I think when you consider that the US dollar, if anything, I think has probably got the potential to have a stronger year than expected next year. I think those 4 rate hikes from the Federal Reserve are going to be apparent next year. I think there's even the potential for some more. So that's the real risk, I think, is that US dollar strength.
Stephen, thanks so much for all your support throughout the year on the program. Have a great Christmas, and we'll look forward to seeing you next year.
Thanks again, Andrew. It's been great to be here. All the best.
We're going to take a short break, but coming up, Tony Sycamore from Commonwealth Bank will tell us about where the momentum is building on currency charts leading into 2016.